Okay, learn to trade, Module 1, Wall Street terminology. Okay, now, market terminology. First, we must start with the bulls and the bears. Now, the bulls are in control when the market is moving up, and that's considered a long position. You make the money in the uptrend. Now, the bears are in control when the market is moving down. All right? Now, you hear on TV, there's the people that say, I make money while the market's moving up and the market's moving down. Well, that's where you get the terminology short position. Now, how you make money on a short position, first of all, you have to make sure that the market is moving down or your particular stock is moving down on bad news. All right? So what we do is we're going to borrow. All right? It's just like buying a stock, but except it's borrowed from the broker and it's going to be returned at a lower price for profit. So therefore, what we're going to do is we're going to borrow the stock from the broker and we're going to return it at a lower price for profit. So let's say that you purchase the stock on a short position at $10. The stock goes down to $8. The delta is $2. That $2 is your profit when you return the stock to the broker, and it's just the opposite of going long is going short. All right, so let's move on to market indexes. Well, first of all, I told you the largest companies are in the Dow Industrial. All right, and there's 30 of them. That's all there's in that Dow Industrial. All right, and then we have the Standard & Poor's 500, and those are considered large companies. And both of these are the benchmarks along with the NASDAQ. Now, the NASDAQ basically is made up of 5,000 companies, and they use 4 or 5 letters. So now we know that the Dow Jones uses 1 to 3, and the Standard & Poor's is a mixture of. All right. Then what we have is the total market is comprised of 10,000 companies. Later in the program, I'll show you how to filter down to the stocks that you want to trade. All right, so if you like trading ones with dividends, I'll show you how to do that. So it's kind of easy. We're going to go step by step. And if you need to come back to one of these to look at, you can look at it any time. If you want to play it once, twice, 3 times, think of it. We all learn in small increments, and this is a lot of information. But one of the things about the information that I'm giving you is that it's all been researched for you. So this would take you a long time to learn if you didn't take a training program like this. Okay, so let's go to company sizes. First of all, we have mega cap. That's over $100 billion. Large cap is from 10 billion to 100 billion. Mid cap companies are 1 billion to 10 billion. Small cap are 100 million to 1 billion. And micro cap are 100 million, and nano cap is below 10 million. Okay, so now let's take a look at some stocks, types of stock symbols, and I mentioned that before. New York Stock Exchange or an American Stock Exchange, 3 letters or less. Examples are AT&T is T, Alcoa is AA, Caterpillar 3, and we have ExxonMobil, which is 3. And typically NASDAQ has 4 or 5. All right, so that's some more information that we have, and I'll go to the next slide. Well, let's talk about what type of trader we're going to be. First of all, everybody's heard of day traders, all right? And day trading is the most difficult, the most stressful of trading. But let's just go through the different scenarios and see which one fits you. Day trading is buying and selling throughout the day, and the day trader closes his position at the end of the day. And the reason for doing that is he doesn't want to get caught in a gap down. So you can lose money on a gap down. Now, it's very nice if the market gaps up. So let's say the trader decides to buy 1,000 shares of XYZ at 10:18 in the morning, and while the stock is rising on good news, and then he decides to sell that stock for $1 profit at 10:40. So the scenario goes, at this point you can go play golf. You already made $1,000 for the day. And what we find is the best time if you're going to day trade is from 10 a.m. to noon. And because people go to lunch afternoon, right? In the afternoon, a lot of times there's some sell-off. And if you watch whatever stock you're trading, there's a point in the day that it rises and then it starts to fall off. So you have to be conscious of that. All right? So you don't want to be trading at the open of the market, because what happens is the orders are still there from the night before. People put in orders. So you could go into that stock, say it gaps up. Well, chances are it's going to go down. It's going to travel downward a little. All right? But that doesn't mean it'll do it that way every day. I've seen stocks where it gapped up and continued to go run for the day. But that doesn't always happen. So you just don't want to get caught in something that is completely out of your control within seconds. Okay, let's talk about the most popular one. And this is the one that basically I do. All right? Because what happens is, with my lifestyle, this fits great. What happens is it gives me a chance to analyze a stock, to look at the stock, pick where the technical analysis is best for me to get in. And so the style of trading I do that attempts to capture gains in the stock market in 1 to 4 days. I don't have to be greedy. So swing traders use technical analysis to look for stocks with short-term price momentum. These traders aren't interested in the fundamental or the intrinsic value of the stock, but rather in their price trends and patterns. So that's what a swing trader is. Now let's take a look at a position trader. Well, a type of stock trader who holds a position for a long term, for months to years. Long-term traders are not concerned with short-term fluctuations because they believe that their long-term investment horizons will smooth these out. So many position traders will take a look at a weekly or monthly charts to get a sense of where the asset is in a given trend. Position trading is polar opposite of day trading because the goal is to profit from the move in the primary trend rather than the short-term fluctuations that occur day to day. Okay, now this is my disclaimer. Trading is a risky business, but it's still a business. How do you minimize the amount of risk is up to you. So you need a solid education in concepts. You're always going to be reading some sort of book or taking some sort of training program. First of all, there is no magic software. I'll never forget that one time, I'm not going to mention the platform I was using, but you can put in your own little black box. Now the interesting part is it did make money at the end, but the amount of trades it made, see, it got stuck at the 50-day moving average, and it would just go above it, come back down, and it must have done that 50 times in one day. 50 times in one day, and you add the amount that it costs for a trade, you had a lot of excess trades. So with that being said, I don't think I'll do black box again. You need to do technical and fundamental analysis depending on what type of trader you're going to be. It doesn't hurt to look at the fundamentals of any company. The most important thing is when I show you how to look up fundamentals and to get a second opinion on a stock trade. I'll show you how that's done. It's all done for free. It's not like you have to buy more software or anything like that. I'll show you how it's done. You need to know the trend and the news of the day. If at 10 o'clock, well, let's do it this way. At 10 o'clock, maybe the housing report comes out. All right, and the housing report says that home sales have priced downward sharply. The market is not going to move up. It's going to go backwards. It's going to retreat. It's going to become bearish. So you may want to look at something like a housing stock, and since you know it's bad news, at 10 o'clock, bingo, you're going to watch that stock go down. But these are things you have to develop and learn, and that's why you're going to have your practice account. All right? The most important things is you have to have practice risk management. So in other words, you're going to have 3 things you need to know. Where you're going to enter the trade, where you're going to exit the trade with a profit, and you need a stop just in case the trade goes against you. We're going to practice all that. Okay, this is the conclusion of Module 1. Stay with me. You're going to learn a lot. You're going to get your money's worth, guaranteed.